Hello and welcome to this video on the balance of payments. In this video, we're going to look at what is meant by the balance of payments and in particular the current account. We're then going to look at the relationship between the exchange rate and the current account, and then finally look at the UK's current account position. So let's get started. What do we mean by the balance of payments? The balance of payments is a record of transactions between one country and all the other countries in the rest of the world. So we're trying to measure the performance of an economy by comparing or looking at how it's interacting with other countries around the world. So in the UK, how do we put together the UK balance of payments? Well, the UK balance of payments summarizes all the money flows into and out of the UK. Money in is a plus, and we call that a credit, a positive amount to the current account or to the balance of payments. And money out is a minus, and we call that a debit to the balance of payments. All the transactions that take place that result in money flowing into and out of the UK are classified into three main accounts. Here's a quick snapshot so we can have an idea of what we're talking about. This is a summary of the balance of payments in 2012, and what we can see is a record of financial flows of money into and out of the UK. Credits here, this is money that is coming into the UK, and debits, that is money that is leaving the UK. And so what we can see here straight up in terms of goods and services is that more money left the UK, more money was spent and left the UK than was received into the UK. So the balance of payments is a record of the financial transactions between one country and the rest of the world. And as I said before, it's summarized into three main accounts. So we group all the transactions that take place into three accounts: the current account, the capital account, and the financial account. In theory, when you add the balances of these three accounts together, it should come to zero, and hence the balance of payments. Let's have a bit more of a detailed look at what type of transaction we would include in each of these accounts. The first account is the current account. In this account, we record the trade in goods and services. So an export, something that's made in the UK and sold abroad, is money coming into the UK. The export leaves the country and we receive money coming in. So an export of a good is a positive credit to the current account. An import is the reverse. For an import to take place, something has come from abroad into the country and money has gone in the other direction. So money has left the country. So we would say that's a negative on the current account, that's a debit. So in the current account, we have the balance of trade in goods and the balance of trade in goods, exports and imports. We also have the balance of trade in services. So things where there isn't a physical product that takes place in the transactions, something like legal advice. There's no physical product, but it's service. Again, exports that we export abroad is a positive, that's money coming in. Imports, imported services, people we hire from abroad, is money going out. We also have another category here called other income. And other income is any profit that's from abroad. So for example, if you owned a business in China and that Chinese business generated a profit and that profit came back to you in the UK, that will be a credit to the current account. That's a positive amount. Likewise, if there's a business based here that's owned by people abroad and the profits leave to go abroad, then that will be a negative, a debit. The final category in the current account is what's known as transfers, and that's money given to the EU, for example, or money sent to another country. So if people send money home to a home country, that money leaving the country would be called a transfer. Okay, the second account is the capital account. And in this, we record transactions in fixed assets, and it's generally quite a small account. So for example, if an immigrant comes into the UK and brings with them some assets from home, a car, for example, that we wouldn't classify as an import. It's not been bought. It's not been bought by someone. It's not a good that's been bought from abroad. It's just been brought with them. There's been no transaction necessarily in terms of buying and selling. The transaction is just the movement. So movements in those types of fixed assets we record those in a capital account. Assets coming in, credit, assets leaving, debit. The final account where we record transactions with abroad is the financial account. In this account, we include things like foreign direct investment. So foreign direct investment, we're purchasing machinery or factories abroad. So say a UK-based company bought and set up a factory abroad, and to do that, money left the country and went to China. That will be a debit on the financial account because that is money leaving the country. On the flip side, purchasing stocks and shares. If an American investor bought shares in a British or UK football club, that will be money coming into the UK, would be a credit on the financial account. But just remember that any income from investments, any income from stocks and shares, not the actual purchasing of the stocks and shares, will be included in the current account. So these are our three accounts, but the one we're really concerned with is the current account. That's the most important for our purposes. Okay, so if we look at the current account, we need to be able to use some terminology here. Let's imagine, in the first scenario, that imports are greater than exports. So the money we're spending on things from abroad is greater than the income we're earning from things we're selling abroad. In this situation, where the outgoings are greater than the incomes, the negatives are greater than the positives, we would say that there's a current account deficit. The second scenario, if incomes and exports were greater than imports or outgoings, we would say the account is in surplus. The positives outweigh the negatives. The last one there, if imports are greater than exports, again, that would be a deficit. So we use these terms of deficit and surplus to describe our current account position. So what might be a reason why a country would have a current account deficit? Well, effectively what we're talking about here is why are they not exporting very much, or why are they importing a lot more than they export? So one reason might be to do with poor price competitiveness. It's a high level of inflation in an economy, higher than trading partners. Prices of products in the UK are rising faster than, say, France. What you'd expect to see is less UK products being sold in France and more French products being sold in the UK. So more imports, less exports, and a current account deficit. Maybe it's to do with non-price competitors, non-price factors that are making our products not competitive, like low levels of investment in research, so the products aren't very good quality, so people don't want to buy them. So we have low levels of exports and high levels of imports. The currency value, the exchange rate, will have an impact, and I'll come back to that a little bit later on. Recessions in other major trade partner countries might be a reason. So for example, if there was a recession in the Eurozone, then there'd be maybe less demand for UK exports, and that might mean more of a current account deficit. The last one is volatile global prices, particularly if it's a country that imports or exports primary commodities, things like metals and foodstuffs. If the prices are quite volatile, they might suddenly be hit by a fall in price, and therefore the value of their exports goes down. Okay, what might be the problems, economic problems that arise from trade deficits? Well, a loss of exports will lead to a less demand for products that are being made within the economy. So if people don't want to buy your exports, that will slow down your rate of GDP growth and reduce living standards. Again, if people don't want to buy your exports, there may be a loss of jobs that may occur as a result of that. And the final point is that by importing a lot of things from abroad, that can weaken a currency because you need to sell your currency in order to import from abroad, and can also lead to higher inflation. The flip side of that, there may be some problems from running trade surpluses as well, having higher exports than imports. If there's a lot of demand for exports and GDP is close to capacity, that could result in demand pull inflation. If a lot is being manufactured in a country but they're not being consumed, rather exported, then that might indicate a low standard of living for people within that country. They're not consuming them, they're making them and then exporting them. And again, high price commodities might be a reason why you have a trade surplus, but if these high prices don't last for long, there could be a problem in that the surplus may disappear. What's coming across here is that there is an interconnectedness of economies. Economies are linked together. The exports of one economy is the imports of another. So one country's exports are another country's imports. And so theoretically, the sum of all trade will be zero. And economic conditions in one country might impact on economic conditions in another. For example, the slowdown in the Eurozone has affected demand for many UK exports, which has affected the UK economy and UK GDP. Here's a snapshot of some countries that have a high level of trade compared to the size of their economy. So these countries are particularly connected with other countries around the world. They're very dependent on trade as a percentage of their GDP. So if you have a current account deficit, a country that imports more than it exports, predominantly, taking into account obviously other income and transfers, what might you do? Well, one common approach is to place a tariff on imports. A tariff is a tax on imported goods, which raises the price of imports and reduces the quantity imported, and instead consumers may choose to consume or buy domestically produced products instead. Again, it does depend on whether the change in the price will actually lead to a change in consumers' buying habits. So we've looked at what is meant by a balance of payments, quite a lot of content there, and the current accounts. It may be worth going back and making sure you've got good notes on those sections. The next was to look at the relationship between the exchange rate and the current account balance, and then we're going to look at the UK's position. So an exchange rate is the price of one currency in terms of another. And what is the relationship between the exchange rate and the current account? Well, if an exchange rate is strong, for example, £1 here buying $3, what it's likely to mean if the exchange rate is strong and the currency has high purchasing power is they're going to buy more from abroad, more imports, and export less. This would move a current account towards a deficit position, more being imported than exported. The flip side is a weak currency. For example, here if a pound was only worth half a dollar, it has low purchasing power, then that's going to make imports less attractive, but the flip side is make the country's exports more attractive abroad. So more exports and less imports would lead to a current account surplus. So there is an inverse relationship between the strength of the exchange rate and what we'd expect to be happening to an economy's current account position. An excellent way to remember this relationship is not to do with the Spice Girls, but SPICED. SPICED stands for strong pound, imports cheap, exports dear, so exports more expensive. So a strong currency value will make imports cheaper, exports more expensive, and lead to a current account deficit. And I would recommend you take that down in your notes. So we looked at the current account and the balance payments. We've looked at the relationship just now between the exchange rate and the current account balance. The final thing is to have a look at the UK's current account position. And as given away there, the UK has a deficit on the current account. And the UK is not alone in that. If you look at the current account positions of several economies added together over time, between 1980 and 2008, so the value of the current account on each year, this is what you get. So a very dark green country up here, very dark green colour, means that that country has accumulated surpluses of approximately $2 trillion worth. So a lot more exports than imports. Very dark red colour means that that country over a 30-year period approximately has imported more than it's exported, roughly $7 trillion worth of goods and services, other income and transfers. So we can see the UK, quite dark red, we've had deficit for quite a long period of time. The USA, very dark red. Some green countries, China, Russia, Saudi Arabia, Germany, these countries are exporting more than they are importing. So the real driver behind this in the UK has been the balance of goods and services. These are the most significant kind of figures. If we look at services first of all on the left, what we can see is actually exports in blue the value of our exports are higher than the value of our imports. So this is an area where we do export more than we import in things like financial services in particular. And so we have a positive balance when we're comparing our trade of these services to other countries. The main reason we have a deficit overall is because a much greater problem is in goods. Here, the imports in goods, the red line, is much greater than the exports of goods, the blue line. So we have a large deficit in the trade in goods. We import a great deal more than we export.
Let's have a look at the UK's current account balance in more recent years. So we can see in 2019, we still have a negative current account balance. Predominantly, it's made up by these blue blocks here, which is the trade in goods. We can still see large deficits in trade of goods. Trade in services is still a surplus. Primary income and other income effectively here is our last components, bringing the total down. So we can see the red line here showing us kind of the overall balance, and there have been some kind of hints of an improvement over the period, but really there hasn't been anything substantial, and the UK still runs a consistent current account deficit.
So why does the UK have a persistent trade deficit? Well, the demand for imports grows strongly when consumer spending is rising. So we have quite strong consumer spending in the UK, and that tends to mean a large demand for imports. A second reason may be to do with exports and some weaknesses in terms of businesses and their ability to supply and sell desirable products to other countries around the world. Perhaps low research and development spending, maybe a low rate of investment in capital and technology and machineries means that actually in terms of manufacturing, our manufacturing base is quite small, and so we don't export particularly much. A third reason might be that many UK businesses find it hard to finance a rise in exports, so they can't borrow the money to then create the capacity or the stock to sell abroad. And a final reason might be that a lot of our British exports, UK exports, go to European countries. And as they've experienced a slowdown in growth, Ireland, Spain, to a lesser extent the USA, then the demand for our exports has decreased, meaning we have more of a trade deficit. Let's now turn our attention to the Greek current account. So this figure here shows us the Greek current account balance changing over time. And really the main thing to note with the Greek current account balance is that it's very seasonal. So we can see high periods of surplus, and then we can see other periods where we have deficits below zero. So we have deficits here and surpluses here. Now overall, on average, they don't quite balance out. Greece has been running a consistent current account deficit for a number of years, with a slight exception in 2015, very, very small surplus. Here we can see the size of the deficit as a percentage of GDP, so to compare to the size of the Greek economy. So we can see historically around maybe 2% and less recently has been the size of the deficit, the current account deficit, as compared to the size of the economy, with the one exception being 2011, which had a very significant deficit during the poor performance of the economy at that period in time. Having said that, the balance is not as significant as perhaps in the UK, but again, we have persistent negative deficits. So what are the factors that influence Greece's current account? Well, as we saw earlier, it's actually quite big variations, periods of surplus and periods of deficit. And if you looked at that chart again closely, you would see that actually the periods of surplus tend to occur in the summer. So Greece has a big inflow, a big credit to the current account occurs during the summer through services, in particular tourism. In the winter time, when those tourist revenues dry up, then we don't have those credits coming in and the debits take over, so we have more of a deficit. So it's highly seasonal. In the summer, we have a current account surplus, and then in the winter, we tend to have a deficit. Unlike other countries, perhaps like Germany, who have very strong exports of manufactured goods. This doesn't apply so much in Greece. So there's a general lack of export competitiveness in terms of manufactured goods. And so when we don't have these big tourism-based inflows, a deficit arrives. So very seasonal in Greece, but over time, we've generally speaking got a small current account deficit. So in this video, we've looked at what is meant by the balance of payments in the current account. We looked at the relationship between the exchange rate and the current account balance, and we've looked at the UK's current account deficit and some of the reasons why that is the case. That's it. Thank you very much.